Ever dream of buying a business? Maybe a cool little coffee shop or something. Well, hold on to your lattes because before you jump into that, we're diving into the wild world of corporate acquisitions.
That's right, and we're going straight to the legal minds over at Ward & Smith for this one. They really know their stuff.
Seriously, these guys literally wrote the book on asset acquisitions versus stock sales. So no better place to get the lowdown.
Definitely crucial to know the difference. It's not always as straightforward as it seems.
Exactly. Okay, so say you're buying that bakery we were just talking about. Picture this asset acquisition is like you're buying the oven, the secret recipe book, maybe even those cute little tables.
Right, you get to pick and choose, and here's the kicker.
Yeah.
You decide which liabilities you're taking on.
Oh, so that's kind of huge.
Oh yeah, let's say the bakery had some, legal issues they were dealing with. Asset purchase, you might be able to skip right past that.
Okay, so that's a big win for buyers, but I'm guessing it's not always a piece of cake, right?
It can get complicated. Imagine having to figure out the value of every single whisk and spatula. It gets detailed. Sometimes you even need separate agreements for things like trademarks.
Oh, wow, yeah, that makes sense. What about that actual bakery space, like the lease on the building?
Ah, good point. That's where those third-party consents come in. Our source really stresses this. The landlord might need to give you the thumbs up to take over.
Makes sense. So yeah, definitely not as easy as just buying a loaf of bread, huh?
Nope, not always. But let's talk about the dough taxes. Everyone wants to know about the tax situation.
Hit me with it. What's the deal with asset acquisitions and taxes?
Well, good news and maybe not so good news, depending on which side you're on. For buyers, it's all about the stepped-up basis.
The basis, is it like a tax break or something?
Kind of. Imagine you buy that bakery's oven for $1 million, but it's actually worth way more now, right? With stepped-up basis, you get to work off that higher value, potentially saving you a ton in taxes later on.
Okay, so less taxes down the line. I like the sound of that.
Okay.
But you said there might be a downside for the sellers.
Yeah, this is where it gets tricky. Think about this. The bakery sells its stuff. They get taxed on that sale. Then, when the owners get their cut, they get taxed again on their end.
Double whammy. So it's not all sunshine and roses then.
Exactly. It's a balancing act for sure. And that's just scratching the surface of asset acquisitions.
Double taxation. Ouch. Definitely not ideal if you're selling your business.
Yeah.
So let's talk about that other option, the stock sale. What's the deal with those?
So with stock sales, instead of buying individual assets, you're buying the whole shebang. Going back to our bakery, imagine you're just walking in, taking over as the owner. Everything's included.
So it's a clean break for the seller. No need to put a price tag on every single oven mitt.
Exactly. Our source says that's a big plus for sellers. No need to deal with valuing everything separately. Just hand over the keys and you're done.
Sounds pretty good from where I'm sitting. But I'm sure there's some things buyers need to look out for, right?
Oh, absolutely. Remember those hidden liabilities we talked about? Those can be a real curveball in a stock sale.
Right, you're not just getting the recipe for those amazing croissants. You might be inheriting some less desirable things too.
Exactly. Unpaid bills, maybe even some legal stuff. It all comes with the company when you buy the stock. That's a big difference from asset purchases, where you have more say in what you're taking on.
Yeah, that's a big thing to consider.
Yeah.
Are there any ways buyers can protect themselves from those unknowns?
For sure. They often put clauses in the agreement, things like saying the seller has to cover certain costs if something unexpected pops up.
Okay, so it's like an insurance policy of sorts, just in case.
Exactly. But even with that, there's always a chance of something unexpected. Buyers really got to do their due diligence.
Thorough research is key no matter what. You mentioned stock sales are usually less complex, but there are still some things to watch out for, right? Like what?
Well, our source mentions these things called change of control clauses. Those can be tricky.
Change of control. What do those even mean?
So say the bakery has a loan, right? And in the agreement, there's this clause that says, if the ownership changes hands, like in a stock sale, the lender can demand new terms or even call in the whole loan.
Whoa. So suddenly you're scrambling to figure out financing. That could really throw a wrench in things.
Yep. And these clauses can be anywhere, contracts with suppliers, the lease agreement, you name it. Buyers really have to do their homework and check for these things.
Okay, so we've talked about the liability side of things.
Mm.
What about taxes? How do stock sales usually shake out on that front?
This is where it gets interesting. Remember the whole double taxation thing with asset sales? Stock sales usually only have one layer of tax.
Oh, that's a relief. How does that work?
It's about who's doing the selling. In a stock sale, it's the shareholders, not the company itself. So the company isn't making a profit from the sale, so no tax there. Just the individual shareholders pay taxes on what they make from selling their shares.
Makes sense. So that simplifies things quite a bit, at least on the tax side.
Yeah.
But buyers don't get that stepped-up basis advantage we talked about, right?
That's the trade-off. In most cases, they don't get to adjust the value of the assets for depreciation. They inherit the existing tax situation.
So potentially higher taxes down the line.
It's possible. But again, it's all about looking at the bigger picture.
Right, weighing the pros and cons, thinking about liabilities, those clauses we discussed, and of course, the tax man.
Exactly. It's different for every situation. There's no one right answer.
So it's kind of like buyers usually prefer asset purchases for that tax advantage, and sellers lean towards the simplicity of stock sales, a real push and pull. Is there any way to find a middle ground, something that works for both sides?
Actually, there is. It's called a Section 338 election, kind of like a hybrid of the two.
A hybrid? Okay, now you've got my attention. How does that work?
Basically, it's a way to treat a stock purchase like an asset purchase for tax purposes.
So you're buying the stock, but the IRS is like, nope, we see this as an asset purchase. Sounds a little too good to be true.
Well, there are some hoops to jump through. Our source makes it clear that both the buyer and seller have to agree to it, and it has to meet certain criteria.
Gotcha. So who benefits most from this whole 33810 thing?
It usually works out best for the buyer. They get that stepped-up basis, so they can potentially save a lot in taxes down the road.
Makes sense, but I'm guessing the seller might not be as excited about it.
You're catching on? Remember that double taxation we talked about?
Yeah.
Yeah, that can still be a factor with the 338 election, even though it's structured as a stock sale.
Oh, so the seller might end up with a bigger tax bill.
It's a possibility. That's why it often comes down to negotiation. The seller might agree to it, but ask for a higher price to make up for the potential tax hit.
So finding that sweet spot where everyone's happy, it sounds like there's no magic formula when it comes to choosing between asset and stock deals.
You nailed it. Legal stuff, taxes, the goals of both sides, it all comes into play. You really have to dig into the specifics of each situation.
Absolutely. Well, we've covered a ton today, from the basics of these deals to those more complex things like 33810 elections.
It's been great chatting with you about it all.
Likewise. And to everyone listening, here's something to think about. If you were in the market for a business, what would matter most to you when deciding between an asset or stock sale? Something to chew on. Thanks for joining us for another deep dive. We'll catch you next time for another deep dive into a new topic.